Brad Garlinghouse just received Business Leader of the Year at Emerge Americas in Miami. The same week that Iran walked out of nuclear negotiations in Pakistan, the Trump token sits 96% below its all-time high, and Wednesday's FOMC meeting carries a 99% market probability of a rate pause that would be Jerome Powell's last major policy decision before his term ends. Tonight, we connect all four of those developments because they are not separate stories. They are four dimensions of the same macro moment, and understanding how they interact is what positions you correctly for what comes next in crypto. This is a complete 20-minute breakdown. We are going to cover Garlinghouse's Business Leader of the Year recognition and what his institutional positioning, Miami to Washington to Las Vegas, tells you about where Ripple sits in the financial power structure right now. Then, the FOMC on Wednesday, the mechanics of a rate pause in the current inflationary environment, why this specific FOMC carries more weight than any in the past 18 months, and what CME FedWatch's 99% probability of a pause means for risk asset pricing in the 72 hours that follow the decision. Then the Iran negotiation breakdown, Iran's delegation arriving in Pakistan and leaving without meeting U.S. officials, and what the continuing Strait of Hormuz closure means for the macro oil dynamics that are building a pressure system underneath the entire global economy that the crypto market is not yet pricing. Then the Trump token, the honest autopsy of a 96% collapse from $75 to $3, what it tells you about the structural difference between speculative meme assets and utility-driven infrastructure assets, and why the Clarity Act's impact on the meme coin category specifically is the regulatory development that redirects that capital. And then the crypto rally thesis, where we actually are in the cycle, what the open interest reset plus the FOMC pause plus Las Vegas announcements plus institutional ETF flow recovery produce when they converge in the same week. This is not financial advice. Nothing here is a recommendation to buy, sell, or hold any asset. This is educational analysis based on publicly available institutional records, CME derivatives data, geopolitical reporting, and documented market structure developments. Always do your own research and consult qualified financial professionals before making any investment decisions. If this is the channel that connects the FOMC, Iran, the Trump token collapse, and XRP Las Vegas into one coherent macro picture, hit the like button right now. Subscribe with the bell on. Let's go. Start with Brad Garlinghouse and the Business Leader of the Year recognition, because the context of this specific award at this specific event tells you something about where Ripple sits in the institutional and municipal power structure that a press release does not capture the same way. Emerge Americas is not a crypto conference. It is a technology and innovation conference attended by the executives, policymakers, venture capitalists, and municipal leaders building the next economic infrastructure across the Americas, North, Central, and South. The Business Leader of the Year designation at that event is not a crypto community popularity contest. It is a recognition from a cross-industry audience that includes financial institutions, healthcare systems, AI companies, and municipal governments, the people who are evaluating which technology leaders they want to build partnerships with. Garlinghouse receiving that recognition at a conference of that composition is the institutional community saying publicly that they regard him as the leader of an enterprise-grade company building real infrastructure, not as the CEO of a speculative cryptocurrency project. That distinction matters because it is the same institutional community that is writing the checks for the $127 billion in cumulative XRP ETF inflows, that is signing the BBVA and DBS and Kyobo life insurance custody partnerships. And that will be in the room when the Clarity Act markup produces its next decisive legislative moment. Chris Larsen, Ripple's chairman, holds the senior governance position in the company's structure, and the combination of Larsen's institutional relationships built over 2 decades and Garlinghouse's operational leadership executing the institutional partnership pipeline is the specific leadership pairing that has navigated the SEC lawsuit, built the ODL corridor network, launched RLUSD into production, and positioned Ripple Custody as the custody solution that globally, systemically important banks are now deploying. The people who question whether Garlinghouse is trustworthy are not writing the NDA-protected partnership agreements with the financial institutions that are deploying Ripple's infrastructure. The institutions writing those agreements are the answer to the trustworthiness question, and their behavior speaks in contracts and custody deployments rather than in social media commentary. Now, the FOMC on Wednesday, because this is the macro event that the entire risk asset market is positioning around right now, And the 99% probability of a pause deserves precise contextual framing rather than a simple rate staying the same is bullish headline. Jerome Powell's term as Federal Reserve Chair ends in May 2026. Wednesday's FOMC meeting carries the weight of being one of his final policy decisions, possibly his last significant one before his successor is confirmed. The CME FedWatch tool's 99% probability of a pause reflects the overwhelming consensus across interest rate derivatives markets that the Fed will hold the federal funds rate target unchanged. What the pause means in the current context is more nuanced than it appears. A pause is not a cut. It does not inject new liquidity into the financial system. It signals that the Fed believes the current rate environment is appropriate given its dual mandate assessment of inflation and employment. The market interpretation that is driving risk asset optimism around the pause is based on the expectation sequence: pause now, then cuts begin in the second half of 2026 as the economic data justifies easing. The forward rate curve embedded in CME derivatives pricing reflects that expectation with cuts beginning as early as July. If Powell's final FOMC statement on Wednesday signals any acceleration of that timeline, any language suggesting that the conditions for cuts are approaching faster than previously indicated, the impact on risk asset pricing is immediate and material. Crypto has historically been among the most sensitive asset classes to Federal Reserve forward guidance because it is priced as a high-duration risk asset where the discount rate assumption embedded in institutional valuation models moves the most when rate expectations shift. The 72 hours following a dovish pivot or dovish-leaning pause language from a Fed chair who is weeks from the end of his tenure and who has no personal political incentive to manage his legacy through hawkish restraint in his final meetings is the specific window that risk asset positioning is pricing around right now. The uncertainty is not whether there is a pause. It is what the language around the pause says about the path that follows. That language matters more than the decision itself. Now, Iran, because the geopolitical situation around the Strait of Hormuz is the macro risk that the crypto market is most systematically underpricing and that the FOMC's rate path cannot resolve regardless of what Powell says on Wednesday. Iran's delegation arrived in Pakistan for what were described as indirect negotiations with U.S. officials mediated through Pakistani diplomatic channels. They left without meeting U.S. officials, and Iran subsequently stated publicly that it will not accept what it characterized as extremely tough U.S. demands, denying that it had requested direct talks in the first place. The diplomatic interpretation. Both sides are managing domestic political constraints simultaneously. The Trump administration needs to show maximum pressure producing results. The Iranian government needs to demonstrate to its domestic audience that it is not capitulating to American demands. The Pakistani mediation channel is the lowest commitment format available. Both sides can engage without publicly acknowledging that they are negotiating. When Iran walks out of even that format, it signals that the gap between the two positions is wider than the back-channel engagement suggested. What this means for the Strait of Hormuz specifically, the closure that has been in effect for approximately 2 months, the longest sustained closure in modern history, is not on a trajectory toward near-term resolution. 15% of global oil supply is offline. The paper price of oil and the physical delivery price are running approximately $40 to $50 apart. That spread is the financial market's delay in acknowledging the physical supply reality, and that delay does not persist indefinitely. When the spread closes, and physical supply constraints always force it to close eventually, the inflationary impact moves through the entire commodity supply chain. Oil, fertilizer, plastics, industrial gases, jet fuel, everything that runs on petrochemical inputs, which is most of the physical economy. Crypto's relationship with an inflationary shock of that magnitude is genuinely uncertain and depends on which narrative dominates in investor psychology. Risk-off selling that pulls capital out of volatile assets including crypto, or currency debasement buying that drives capital toward assets with fixed or constrained supply as an inflation hedge. The historical precedent is split between those two responses depending on the severity and speed of the inflationary shock. What is not uncertain, if the oil price gap closes rapidly and consumer inflation spikes materially in May and June, the Fed's ability to cut rates in July is constrained regardless of what the rate path looks like today. That changes the forward guidance embedded in Wednesday's FOMC statement and changes the risk asset pricing implications of whatever Powell says. Monitor the Strait of Hormuz situation as closely as you monitor the crypto charts. They are the same story right now. Now, the Trump token, because the honest autopsy of a 96% collapse from $75 to $3 is more useful to you as a crypto investor than any number of analyses of why the project was promising. The Trump token peaked at $75 within days of its launch, driven by the specific combination of presidential identity, extreme scarcity perception, speculative FOMO, and the social proof of seeing prominent figures competing for top holder status. Justin Sun was widely reported as pursuing the maximum holder position, a detail that simultaneously validated the token's perceived prestige and signaled that the buyer at the top of the holder distribution was a sophisticated market participant who knew exactly when to exit. The Melania token launch, announced abruptly and absorbing the liquidity that had been concentrated in Trump token, is the documented mechanism that triggered the initial collapse. What the episode reveals structurally, meme asset liquidity is not deep, it is concentrated. When concentration unwinds, the price discovers its fundamental value, which for a meme asset with no utility, no institutional demand, and no operational use case is approximately zero adjusted for whatever floor the remaining speculative interest holds. The 96% decline from peak is not an anomaly. It is the expected outcome for an asset whose entire value proposition is narrative momentum and whose supply of narrative momentum is exhausted the moment the next competing narrative launches. The contrast with XRP is not about personality or community loyalty. It is about architecture. XRP's price floor is not narrative momentum. It is operational demand from ODL corridors, institutional ETF custody, RLUSD transaction fee burns, and Ripple custody deployments across BBVA, DBS, Kyobo Life, and the globally systemically important banks using the multi-custody orchestration layer. Architecture creates a floor that narrative cannot. Narrative creates a ceiling that architecture cannot. The Trump token taught every person who was in it at the top, including people whose profitable positions evaporated in hours, that the sequence matters. Architecture first, then narrative momentum, not narrative momentum in the absence of architecture. The Clarity Act's meme coin implications are directly relevant here. The SEC's February 2025 staff statement classified meme coins as commodities rather than securities, directing their regulation to the CFTC. CFTC enforcement against fraud and manipulation in commodity markets is the regulatory pressure that most meme coin projects cannot withstand at the disclosure and governance standards that commodity market participation requires. The consolidation that follows is not the end of speculation in crypto. It is the redirection of speculation toward the assets that can withstand regulatory scrutiny. And the capital that exits the meme coin category in that consolidation is the capital that rotates into utility-driven networks with institutional backing, production deployments, and the regulatory compliance record that the CFTC framework demands. Now, the crypto rally thesis, where we actually are in the cycle as of this weekend, and what the specific combination of events this week produces when you evaluate them together rather than separately. The open interest reset on XRP, 71% collapse from October 2025 peak to current levels, the most complete leverage wipeout in XRP derivatives history, is the technical foundation. Compressed open interest means that the next directional move is determined by spot demand rather than by derivatives momentum. Spot demand does not reverse on leverage cascade mechanics. It builds on adoption news, institutional flow data, and macro sentiment shifts. All three of those inputs are moving this week. Adoption news, XRP Las Vegas, April 30th with Garlinghouse and Schwartz on stage, carrying realistic expectations for RLUSD integration updates, XRPL technical announcements, and ODL corridor milestones. Institutional flow data, XRP ETFs recorded $65 million in inflows in April, reversing March's outflow entirely and running consecutive daily positive flows since April 10th, with cumulative inflows at $127 billion and April on track for the single largest monthly net inflow since launch. Macro sentiment, a 99% probability FOMC pause with forward guidance language that the market will interpret as either rate cut timeline confirmation or rate cut timeline delay. And the difference between those two interpretations is the difference between a risk-on surge and a risk-on plateau in the 72 hours following the decision. The SBI VC 6-year data provides the holding context. XRP's 6-year return of 987% against Bitcoin's 2,500% and Ethereum's 2,000% over the same window situates the current price level, approximately 50% below the July 2025 high, within a longer-term return profile that 6-year holders are still significantly in profit on. The reset is not a failure of the thesis. It is the leverage cleanup that precedes the phase where spot institutional demand sets the price rather than derivatives momentum. The people asking whether to buy, hold, or sell XRP at current levels are asking the wrong question. The right question is, what is the adoption curve evidence showing versus where the price is? The adoption curve evidence, Kyobo Life, BBVA, DBS, Goldman Sachs ETF position, $65 million April inflows, XRP Las Vegas, Swell plus Apex in October. The DTCC's second half 2026 service launch is running ahead of where the price is. That gap between adoption evidence and price is the investment thesis in its most precise form. Here's the complete picture of this specific weekend moment and what it implies for the week ahead. Garlinghouse has Business Leader of the Year from Emerge Americas, confirming that the cross-industry institutional community, not the crypto community, regards Ripple as enterprise-grade infrastructure leadership. Wednesday's FOMC, with 99% probability of a pause, is the macro catalyst that either accelerates or constrains the rate cut path that risk assets, including crypto, are pricing into their forward valuations. Iran's departure from Pakistan negotiations without meeting U.S. officials extends the Strait of Hormuz closure timeline and builds the inflationary pressure that will eventually force a reckoning between paper oil prices and physical delivery prices, a reckoning that arrives regardless of what the Fed does on Wednesday. The Trump token's 96% collapse from $75 to $3 is the cleanest available illustration of the structural difference between narrative assets and architecture assets, and the lesson is not that you should have sold earlier, it is that the assets worth holding are the ones whose floor is determined by operational demand rather than by narrative momentum. And the crypto rally thesis, compressed open interest, recovering ETF inflows, XRP Las Vegas announcement expectations, and FOMC pause catalyst, is the four-input setup that the technical and flow data is pointing toward, with the honest qualifier that the Strait of Hormuz macro risk is the external variable that none of the technical analysis accounts for. You cannot chart your way around a physical oil supply shock. You can only make sure you understand it is coming and have thought through the two scenarios, risk-off selling versus inflation hedge buying, before it arrives rather than after. Smash the like button if this gave you the complete 20-minute picture. The Garlinghouse institutional positioning, the full FOMC mechanics, the Iran negotiation breakdown with the Strait of Hormuz oil implications, the Trump token honest autopsy, and the four-input rally thesis with the macro qualifier intact. You stayed for the full analysis, including the uncomfortable parts, the Trump token losses, the Iran uncertainty, the oil inflation risk, and that is the kind of investor who makes decisions with the full picture rather than the comfortable subset of it. Subscribe and hit the bell because Wednesday's FOMC decision and the XRP Las Vegas main stage announcements are both happening this week. And when either of them produces a decisive signal, the full breakdown is here within hours. Tell me in the comments, which of the four inputs, FOMC pause language, Las Vegas announcement, ETF inflow acceleration, or Strait of Hormuz resolution, do you think moves the crypto market most materially over the next 30 days? And be honest about why. See you on Wednesday.